Hello everyone. Today I would like to take you through the final phase of the accounting cycle, and it's called closing the books. So I'm going to walk you through the note very quickly, and then I'm going to show you how we actually do it. So when we close the books, what we're doing is we're saying that our financial period, most likely a year, has come to an end. So we need to clear out some things because we have to start the new year with zero balances. And I'll give you some examples. So on December 31st, we have our party hats on. We're dancing. It's New Year's Eve, having a great time. Midnight hits, and we are now into a new year. It's January 1st. If our business had $100,000 in sales leading up to December 31st, as soon as the clock strikes midnight, our business now has zero sales for the year. So we haven't generated any revenue. So we have to reflect that in our accounts. Similarly, we haven't had a phone bill, we haven't had to pay any salaries, we haven't had to pay any utilities. So those expenses also need to be cleared out. And finally, the owner hasn't taken any money out of the business. So we need to put a zero balance for our drawings if we have any drawings for the business as well. So when we're closing the books, we are going to be taking the balances from what are called temporary accounts, which are revenue, expenses, and drawings, and we are going to make sure they have a zero balance going into the next year. Our assets and liabilities remain the same because if we had $15,000 cash in the bank on January 1st, it's a new year, that $15,000 is still there. If we have a mortgage, the mortgage is still there. If the owner invested money in the business, that investment is still there as well. So here is the accounting cycle that we've done this semester. We've done journal entries and ledgers. We've done trial balances. We did adjusting entries recently. We've done financial statements, balance sheets and income statements, and statement of owner's equity. So now it's time for us to focus on this part of the accounting cycle, which is closing entries, and finally a very quick trial balance, which I'll do at a later date. Okay, so I just went through this verbally. You can look at the slides, but again, it just says that we've got some temporary accounts we need to close and make zero. So the reason we do that is, first of all, we have to prepare our revenue and our expenses for the next year, and those revenues and expenses must be zero. We also have to update our owner's equity account. Was there a net income or a net loss that needs to be given to the owner? Did the owner take money out of the books, and so on? So we are going to do a few journal entries to do this, again, to update our revenues, our expenses, and our owner's equity accounts. So if you have a textbook at home, it's actually going to look different in your textbook than it does the way we do it. And the way that I like to teach it is a little bit easier to understand. And there are 3 steps in closing the books. So what you will do is you are going to close the revenue accounts into capital. That will make no sense to you right now, but when I walk you through the journals, you'll understand what I'm talking about. The second step is we do the same, except we close expense accounts to our capital, and finally we close our drawings to our capital account. So when we say we are closing it, we are going to take the balances from all of our revenue accounts and put them into capital, our expense accounts, put them into capital, and our drawings and put them into capital. Now, why do we do this? Because when the business makes money, that's revenue, that belongs to the owner. So why not give that money to the owner? When the business has an expense, again, the owner has to pay that. So we are going to pull that money away from the owner in the capital account. And finally, if the owner takes money, his or her stake in the business or investment in the business goes down. So we need to reflect that in the overall capital number. What will happen when all this is done is we are going to go back to day 1 of the accounting course. We will only have assets, liabilities, and an owner's equity account because all other accounts will have a balance of 0. So instead of continuing with chapter work, what I'm going to do is walk you through an example. Okay, so here is Clark Co. This is their trial balance for December 31st, 2000 whatever. And in a trial balance, if you recall, we list our assets, liabilities, owner's equity, revenue, and expenses. And this just lets us check if our debits equal our credits. So if I were to add another column here, another row, we know that this is debit and this is credit. So we know our assets have a debit balance, our liabilities and capital have a credit balance, drawings have a debit balance, revenue credit, and expenses with a debit. So we know also, as I said earlier, that in the new year, we're still going to have assets because they don't disappear overnight. So we don't lose our supplies, for example. Our land doesn't magically go away. We still owe money to people, so our accounts payable and our mortgage will still be there, and the owner has still invested money in the business. So what I suggest to students when we are doing this in writing is I ask them to actually put a line, draw a line right here to differentiate where we are closing and what we are leaving alone. Because I'm doing this virtually on a computer, this is what I'll do just as a visual right now. All of these accounts here do not come into play when we are closing the books. So I'm just going to do a little visual here, and let's put it in red. Don't touch these things, okay? So that's actually a little bit bright for my old eyes, so we are going to change that, and let's do a nice gentle yellow color. Okay, so the first step I'm going to do is I'm going to close my revenue into my capital. So this is what this means. These are my revenue accounts right here, and I know they have a credit balance. So if I want to make the sales zero, what I do is I'm going to debit it $55,000. So I'm going to go down to my journal, and it's the 31st of December, and I'm going to say sales, and then I believe it was fees earned. Because they have a credit balance, I'm going to put in 55,000 and 18,000, 55,000 and 18,000. So by debiting them, those accounts now have a zero balance when I look at them on January the 1st. And what I want to do, it's M. Clark Capital. I want to give that to the owner, M. Clark Capital. So I'm going to add these two numbers together, and that is 55 plus 18 is $73,000, I believe, 55, 65, 73. And I'm going to say to close revenue for the year. Now, we can see the impact. Capital is a minus plus account. So right now, the owner has earned or made an additional $73,000 from his or her sales or fees earned for the year. So that's step one. Step two is we're going to do the same for our expenses. If we look here, our expenses have a debit balance, so they have the proper balance. To close them, to make them zero, we have to credit them the same amount. So I've got ads, salary, and utilities. Because I'm going to credit them, I have to put capital first, because I always put my debits first. So it's M. Clark Capital. And I don't know what I'm going to do in the balance yet because I need to add it all up. So once again, advertising, salaries, and utilities. So advertising, expense, salaries, expense, and utilities, expense. And let's look at the balances, 5, 7, and 3. So now what I'm doing is I am going to give that balance, sorry, there's a minus sign here, to the owner. So that is $15,000. And that is to close expenses for the year. So what I've done here is we know that capital is a minus plus account, so it increases with a credit. We're pulling that $15,000 away from the owner. So what we've done with these two entries, with first of all closing our revenue, we gave the owner $73,000. With closing our expenses, we subtracted $15,000 from the owner, and then that essentially means we have given the owner the net income for the year. because $73,000 in revenue minus $15,000 in expenses gives us a net income for the year, and the owner's capital will have been updated as such. Finally, what we need to do is we need to close our drawings. So drawings is $3,000. It's a debit account. So we must, once again, do our capital first, and then we're going to close our drawings. And because my memory is not good, I always forget it's $3,000. And to close drawings for the year. And that is closing the books. So in summary, what I've done is I leave my assets and my liabilities because they remain the same once we turn over to a new year. I have taken my revenue accounts and I have made them zero by debiting them. So sales and fees now have a zero balance going to the new year, which is what we want because we haven't earned any money yet. I then closed my expense accounts. They are a debit balance, so I've credited my expenses, gave that to the owner, and finally I closed my drawings account because the owner hasn't taken any money out of the business in the new year yet anyways. So the net effect is that the owner's capital has received the net income and we've taken away the drawings, and that capital account is now updated for the new year as well. When we do a trial balance now, it will only show our assets, our liabilities, and our updated capital, and left side should equal right side. So that is closing the books. Again, in your textbook, it's going to look different. You are going to see a temporary account called income summary, and they show you a 4-step process in closing the books. Please ignore the process that they use in the textbook because it adds an unnecessary step and adds an account that exists for exactly 4 entries for the year in income summary. So we do not need to use that step. Simply close your revenue into your capital, your expenses into your capital, your drawings into your capital, and you've updated your books. So that is your tutorial on closing entries. There's some textbook questions you can work on. I will also post a few exercises, and this will lead into our summative where we will look at 8-column worksheets and closing entries. Take care, everyone. Reach out at any time with questions.